Brian Grimes, your real estate mentor, here with the top 20 most undervalued real estate markets in the US today. Make sure you stick around to the end because I'm going to reveal the top 20 list. You want to see if the market that you're in or the one that you're thinking about investing in is on this list. If you're new to the channel, like, comment, subscribe. Leave a comment that says, I subscribe. For everyone who leaves that comment, I'm going to send you instant access to my free real estate training. It'll show you how to acquire properties for pennies on the dollar all across the country. You don't want to miss out on that free offer. So let's get straight into this thing, guys. I want to break down this information, but first let's just set the table. So this is an article from usnews.com, and it's breaking down these markets. But let's set the table on the information that we need so we can get the full value out of this information. Everything in real estate is about having a macro view. Once you understand the macro view, you can apply that knowledge to your market and make millions of dollars. So let's set the table here. During the earliest months of 2020, prior to the pandemic-related lockdowns in the US, the housing market was continuing to gain strength on the back of solid but slow-growing economy with low unemployment. In January of that year, thanks to a 30-year mortgage rate ranging from 3.6 to 3.7%, the median priced home was more affordable than renting, fueling demand from renters who are eager to buy their first home. And here's where the information gets a bit juicier, with typical tenants paying 33% of their monthly per capita income on rents, and the average homeowner paying just 22% on their monthly per capita income on mortgage payments. Making the switch from renter to homeowner often made greater financial sense. So we have a scenario here coming out of the pandemic and kind of around that time where, as rates were still very low, the Fed is just like helicopter money into the economy, just printing money. It was a great time to shift over from renting to buying because homeowners were only paying 22% of their income on these properties because the monthly payments were so low. Rates were low. Everything was kind of booming. Housing prices hadn't jumped as significantly as they have over maybe the last year, even though they were rising at a pretty rapid rate. Inflation has been going on. But you're seeing that discrepancy between this 33%. Let me zoom in on this. This 33% that the renter is paying, the 22% that the homeowner is paying. So because this is a macro game, this is a supply and demand game, we always want to know, when is this a good time to buy? Is it a buyer's market? Is there strong demand for these properties? If you're buying and flipping, you want to see this strong demand. You want to know that people are looking to buy properties. It makes a big impact on your bottom line. And if you're doing this cash flow game, you want to know kind of what the market is doing. So let's get into it a little bit further, and then we're going to get into these top 20. So make sure you stick around for those top 20. Like, comment, subscribe. Leave a comment that says I can subscribe so I can send you guys that free training. I want to send you the free training, but you got to subscribe. You got to drop the comment. I can't give it to you without that. Without that, it's quid pro quo. Quid pro quo. So, however, by the end of 2022, as both mortgage rates and home prices continue to rise sharply, the payment ratio difference between owning and renting have flipped. This is as rates went up. This started to flip on us. So while the share of monthly per capita incomes paid by tenants to landlords rose just a few percentage points to 36% because rents increased, for homeowners, it jumped to 37%. So that gap that we had, that gap between the 33% and the 22%, just got erased. So now it quickly pivoted because rates increased to the point where it wasn't cheaper to own versus rent. So that demand, that shift, that incentive, it went away. And a lot of market demand just left the market. When market demand leaves, those supply demand metrics that truly drive real estate, they kind of get topsy-turvy. They get flipped upside down and the market will start to change a bit. So getting back into it, and then I want to jump into these top 20. Since these are national median figures, these same ratios will vary a bit between markets. Real estate is a micro market. So you don't want to, as you're getting into this macro view, you don't want to get so macro that you forget that a lot of the news on the macro level is clickbaity. Like they just want to get views and clicks on the national media channels, the CNNs. Like they just want to get those clicks. Your real estate market is micro. It is a micro market, micro local. So what's going on in LA is not what's going on in Philly. What's going on in Chicago is not what's going on in Baltimore. So you want to be tapped into your micro market and know what's going on, but you need to know the macro trends so you can see if your market is doing better than the national average. So homeowners paying up to 67% for their principal and interest, and renters were paying up to 58% in most of the overvalued markets. These would be like on the West Coast where things are just super overvalued. And in parts of like New York, they say like the Bronx, almost 80% of the people who live in the Bronx rent, and they pay a lot because New York is expensive on rent. So there are some renters nations out there, renters cities, renter states out there. At the end of the spectrum, in the most undervalued markets, homeowners are paying below 25% of the median per capita incomes for mortgage payments and below 27% for rent. So what are the key findings? And you'll kind of like some of these markets. Some of these markets are the markets that I'll talk about. We'll get to the top 20, but these are like the top 5, we'll call them. So from the key findings, the most undervalued markets to purchase a home are located predominantly in the Midwest and near the East Coast. So you guys know I'm an East Coaster, born and raised in Philly. And I'm all about the East Coast. I'm telling you, the East Coast is the best place to invest for cash flow. And as we get deeper into this article, I'm going to show you exactly why, because they break it down in great detail here. And a lot of these top 10 markets, top 20 markets are in the East Coast. But this is just showing you those markets. So the East Coast is definitely there, led by Detroit, Cleveland, St. Louis, and Philly. Looks like we made it. The most undervalued markets to rent a home are located in the Midwest, led by Omaha, St. Louis, Cleveland, and Kansas City. And we're going to talk about why we don't necessarily want the area that we're going to invest in if we're a buy and hold investor, if we're investing for cash flow, so we can have that money coming in, rain, sleet, hail, or snow, so that we can leave the 9 to 5 and just retire on that rental income. We don't necessarily want that our property to be located in this undervalued rent market where rents are suppressed. We want those rents to be high, and we want the prices to be low. So there's a sweet spot, and there are a couple of locations that will fit this, and I'm going to break that down. So just stick with me here. You'll save the most buying versus renting a home in Detroit, Philly, Cleveland, and Chicago. Chicago is definitely on that list. I've seen some crazy deals in Chicago recently. One of our masterclass students, he's in Chicago, and we were looking at deals. And he's just like, Brian, pop up your screen and let's just look at some deals in Chicago. And we're looking at multis, and it's like, man, you can buy them for $120. They're worth $450 when you're done with them. They got the big developer spread I talk about, where you can go in and do a full gut renovation. There's just so much value for anybody who's in or around that Chicago market. You need to tap into the mentorship program, because you're sitting on a gold mine of opportunity. There's a lot of money to be made, and not even in the deep hood. What I say about investing in C-class is every good neighborhood has bad pockets. Every bad neighborhood has good pockets. So there's some good pockets you guys can make some money in. So let's get into the top 20. You guys have stuck with me for a while. I want to get into undervalued homes for sale. We already know we have these markets. Detroit is kind of leading it. So if you're in the market to purchase a home, the following five MSAs are the most undervalued, with a payment to income ratio below 24%. This ratio is well below the maximum rate recommended by HUD and significantly below the national average of 37%. So this is definitely, if you're in buy mode, if you're just starting off with little to no cash or limited cash, and you want to get your first property, you want to look at some of these areas, especially if you're in overpriced markets. If you're in LA, if you're in New York, if you're in some of these areas like Miami, where the housing prices have just skyrocketed, you want to look to where your money can go further. So you want to look to some of these undervalued markets. Let's break down all of them. We know Philly's on there. We know Cleveland's on there. We know Detroit's on there. St. Louis has some incredible multifamily housing stock. Incredible for dirt cheap. Cincinnati's on there. Here's the top 20. So I'll go through this list slowly. I'll show you. I mean, Detroit's up top. We have Cleveland's there, St. Louis there, Philly, Camden, Wilmington, Maryland, DE. Baltimore's definitely on this list. We got Cincinnati, Chicago. These are top 10s. Oklahoma City, Omaha, Kansas City. Then we got Baltimore. You guys who know me know that Baltimore is definitely on my list. Baltimore is in my opinion, it's one of those areas that's on the top of my list for a variety of reasons, along with Philly. Philly's at the very top. It's at the tip top, because I love rebuilding the neighborhoods. and the community that I came from. That's like my mission, my purpose, at the moment, and maybe long term, is to rebuild the community and communities that are like the ones that I grew up in. But Baltimore definitely fits that mold, and we're going to talk about why Baltimore could be hot too. You want to keep an eye on that. We got Columbus, Ohio, Richmond, Virginia is there, Virginia Beach, Norfolk, for all my Virginia people. You're sitting on gold mines here. Atlanta, Georgia. A lot of these areas in Georgia are pretty ripe, and I've seen some great value there. Jacksonville, Florida. Look up into the northern areas of Florida, Orlando, Jacksonville. Look into Tampa a little bit, although Tampa has been overheated. But there's a lot in the northern tip of Florida. There's a lot of value. Don't always flock to Miami and South Florida, South Beach. That real estate is super pricey, and a lot of people are doing that Airbnb thing, and it's not necessarily going to work out for them long term. If you don't know why, watch my video on Airbnb bust. It's called Airbnb bust, and a lot of people are losing money with Airbnbs right now. A ton of people. And then we got Dallas and parts of Texas. Arlington is a good spot of Texas. My brother's got a crib out in Arlington that's just a beast of a property out in Arlington that he does a little bit of co-living with. But that's another story. That's for another video. So these are the markets. If you're in any of these markets, definitely tapped in. But there's more. So don't run yet. Just because you saw your market, you're like, all right, thanks, Brian. I see my market is one of the most undervalued. I'm out of here. Don't run yet, because there's a little bit more that you need to factor in. Just a little bit more. So this article does a bit of a love fest on Detroit, which I won't get into. It does break down Detroit, and I'll put a link to the article in the description if you guys want to tap in, learn more about Detroit, and because that's the number one kind of what is going on there. But the short and skinny on Detroit is it's not all it's cracked up to be yet. While there is cheap real estate, Detroit, we got to look at this. As of November, the rates of mortgage delinquencies and foreclosure in the Detroit area nearly match those at the national level, although these rates could rise in the event of a recession. So it's like Detroit, there's just massive foreclosures, delinquencies. The city itself, the management of the city is still kind of in question. And a lot of investors are still sitting on the sidelines and not sure, if now is a good time to get into Detroit or not. Now, let's get into this undervalued homes for rent. Now, if you think about it as a cash flow investor, I don't want my rents to be low. What I want to be on that undervalued list in terms of housing prices. So I want my prices to be low because then I can buy in affordably, but I want my rents to be high. If my rents are high and my prices are low, now I can develop a cash flow spread. I can make more cash flow in those cities. So what cities will fit that model in terms of also having kind of, higher rents? So this is the top 20, we'll call it, of low rents. Ranking number one is Omaha. Then we have St. Louis, Cleveland. This is why Cleveland is not necessarily, it does make the list. And a lot of people are like, go to Cleveland. You can get a single family property for 30 grand move-in ready, 40 grand move-in ready, and you can, but the rents aren't high. They're not higher than Philly. They're not higher than Baltimore. So I'm still looking at those other cities and saying, well, these have higher rents and the pricing's low. They're better than maybe a Cleveland at the moment. In some cases, in some parts of Cleveland, in the parts where the real estate is the cheapest. There are some good parts of Ohio, Columbus, where the pricing is really good on the rents and where you can get a big multifamily and still make sense out of it. I'm not saying you're not going to make cash flow. You are going to make cash flow. But the question is, where are you going to make the most cash flow? So I want to make the most cash flow in an area until that area dries up. Then I'm going to go to the other area. Then I'll go to Cleveland and take, the cash flow in Cleveland. So Cleveland's up here. Kansas City's up here. I'm seeing all these in the top 10, and I definitely don't want to be in the top 10. And I'm seeing Philly is like 17th. It's still there, but out of the cities that are the most affordable, Philly's kind of at the bottom because rents are going up. And why are rents high in Philly? Rents, you can also see they're high in Baltimore. Baltimore is like 19, and it's right below like parts of Texas, right? Or right above parts of Texas in terms of rents. So Baltimore rents statistically are stronger. And here are the statistics that are highlighted here, stronger than Philly. And the prices, the property prices are lower than Philly. So that would mean Baltimore is actually a stronger cash flow market than Philly. Even though Philly, in my opinion, is a bigger market. It's a sister city to New York. So there's a lot more value in the immediate future in Philly than Baltimore. But Baltimore is a sister city to DC, which is also a big, expensive city where people get priced out and they want to move to somewhere cheaper. So both of these are sister cities. One has a little bit higher rents in Baltimore and a little bit lower prices in Baltimore. Philly, I think, has more history. It just has more history. If you know about kind of the Constitution and just the history of the United States, Philly has a lot of history. Baltimore does too, but Philly's got a lot of history. A lot of stuff went down. Philly is a sister city to New York, which while DC is a big city, New York is like the city of the world, right? So there's still more demand, higher prices there. So you can get a lot more value, in my opinion, in the immediate future and a lot more price appreciation in Philly, which means if you're buying and flipping or buying and holding for not only cash flow, but appreciation, Philly might outweigh Baltimore, but Baltimore can still make you more cash flow per deal. So these are things that you guys would have to weigh in depending on what you're looking to do. There's a lot more in this article, but look, I'm here to give you the knowledge, break down those top 20, see if you're on that list, give you this info, give you that free training. Once again, if you're new to the channel, like, comment, subscribe, get access, leave that comment that says I subscribe. I'll send you instant access to my free real estate training. It'll show you how to acquire properties for pennies on a dollar all across the country. I'm literally trying to give you free training, but you got to take that leap, guys. Brian Grimes, your real estate mentor. Hopefully this helped. Hopefully this gives you some different opportunities out there. If you want to invest out of town, in your backyard, if you're on these lists. So hopefully this helped, guys. Brian Grimes, your real estate mentor. I'm signing off. I'll see you guys on the next one.